Hey everybody, Marty Mazzora here. It's June 15th, Thursday, 2023, just after the market close. My schedule the next 2, 3 days demands that I do this today, and I'm wanting to anyway because of the action today and yesterday around a number of developments, Fed meeting in particular, but CPI and so on. Tomorrow, this will be sent to you clients for the Friday morning message. And then later tomorrow, if I have my way, you'll get the economic update. I'm going to start on it this evening. Tomorrow morning, though, I need to wait for consumer sentiment to come out. And then I can finish the scoring of the index and tell you what I think. For today, though, I'm going to go quickly through just the daily chart on the S&P, the NASDAQ, and I want to express why this market looks as toppy as it did at its all-time high in the beginning of 2022 in January. Just keeping it simple, there's your daily chart of the S&P 500, and I'll first just zero in on the price chart. So I think the way I want to say it to you, or I want to express it, is this is what a top looks like versus this is what a bottom, or at least a short-term bottom, looks like, right? So from a price chart perspective, we look at various patterns that suggest that the near-term trajectory of the market may be, bullish or bearish. So there's a number of patterns in here, and forgive me for the busyness of it, but like, for example, here's the all-time high, right? And here's the market coming down, and I'll show you the momentum confirmations here in a second. But here we are working into what I would call a falling wedge pattern, which is a bullish pattern. You see we broke out of it here. We had a really nice rally and then began establishing the bear market trend line right there. And then as we came down, right, we had quite the precipitous drop, and it looked like we were consolidating, and I'm certain a lot of people were getting bullish right then, thinking it's all over, but it looked to us more like a bear flag pattern. And as I've shown you zillions of times, what you do is you have a price target, the length of the flagpole. And that actually stopped about right here, consolidated a little bit, then it continued lower, but then it looked like it was flagging again. Okay, so it came up, flag developed, kaboom, came right down. So we actually had two very distinct bear flags. Started to flag again here, just classic. What you do is you consolidate, kind of a counter trend direction, and then you fall out of bed. But then, we bottomed in here, had a nice bounce, but then we had this very suspect-looking consolidation, almost an island reversal pattern. I've shown you those a few times over the years. Then we came, and I was showing you these big gaps down, right? And I draw these gaps because we expect them to be filled, and we did see us fill these gaps along the way, right? Came back up, rising wedge, and then fell apart, big bear flag pattern, played out, just right almost to a T, right there. Consolidated a bit down here, tried to rally, then we hit our first bear market target bottom. And remember these green shaded areas, I was drawing engulfing candles that were just very bullish, and we just had two in a row, and I said, this looks really compelling. And sure enough, so we came through here, and we have these various patterns, and I'll kind of stop there, but the technicals have been working pretty good throughout this bear market. I will say, though, that I've been telling a pretty bearish tone for the most part as it's continued to melt up. But, I did say, like 2 weeks ago when I gave you our update of our monthly update of equity market conditions, I said, the next couple months maybe, looking at inflation base effects, and at least over the next month, looking at a bearish dollar chart, which I showed you again, I think yesterday, that was bullish stocks, and the dollar rolled over today to the tune of 57 basis points, and that's not small for the dollar. So that has played out, and it's played out as we expected for the equity market, at least for the first 2 weeks. So again, that was the caveat. Really negative overall conditions for equities. However, there was a couple of things that I noted that could be bullish in the inner term, and certainly the dollar was one of those things. If it wasn't the catalyst, it certainly, the correlation played out the way it should. Okay, so when we zero in on the momentum indicator spots I just showed you, right? So here, we had that falling wedge, right? And we had very distinct bullish divergences coming from oversold levels. That was just a very bullish near-term look. Then we came and we quickly got overbought, or nearly overbought, and then we quickly had a sell signal, and then we were flagging down, right? And I'm sure we remained relatively bearish in there. And then right in here, you could see we were getting a very long, compelling divergences, at least there in the MACD. And then we got way oversold here on the RSI, and we were wedging down, and again, right at our target, initial target for the bear market. And then looked really bullish, and we haven't looked back, really. At times we've looked back, but we certainly didn't get back to here. Not yet. Our base case is that we do, and ultimately probably below that. So then here we've had this several month move and consolidated for a while, broke out of that very bullishly. However, we really just ended up with kind of the opposite of this, right? We had a long, essentially bullish divergence where the market was plumbing new lows, but momentum wasn't. Now we've got the opposite. So this kind of just flip it on its head. Big bottom. Feels like we're getting close to potentially a big top, and we are more overbought right here than we've been through the entire bull market. Technically, there was only this spot right here where we were above 70 on the RSI, and we are way above it right here. Okay, so let's look at the same for the Qs, the NASDAQ 100 index. I think this is the one to watch, frankly. Same kind of stuff, right? We were, there's a bullish falling wedge, bullish divergence, there we go, right? Bullish falling wedge, bullish divergence. Tried to take off from there, finally caught steam right there, but the divergences were very compelling. So that was a bullish look as well. But then we moved into a bearish pattern up in here, just like the S&P, very close. Okay, so now, no bones about it, we have a rising wedge pattern, and we basically have the same look that we had in the S&P, only massively overbought here, nearly 80 on the RSI. Nothing even remotely like that here. So that is one indicator that has me saying this is as ripe for a pullback as we've seen it since the all-time high back here in January of last year. So the VIX, remember the other day pointed to a bullish falling wedge for the VIX, which would be bearish for stocks. Bullish divergences. We popped it. Literally, we did the video right here, popped it the next day. And I said then, though, that it would correspond with stocks falling. Actually, stocks rose. And then the VIX then succumbed to that, except for today, we ended up with a VIX that was up 4.5% against an S&P that was up 1.22%. The S&P did give up some steam, so that gives you a feel for how high it was right toward the end of the day. So again, still a very bullish look for the VIX, bearish look for the S&P and the NASDAQ. Remember, I think about a week ago, I showed you the long-term kind of relationship between the NASDAQ VIX and the NASDAQ 100 that you need to start looking out when they're both going up at the same time. Well, today, the NASDAQ 100 was up 120 basis points, and the VXN, the NASDAQ 100 Volatility Index, was up 2.84%. So nothing means that the market's going to come crashing down tomorrow or anytime soon. These are just warning signs. These are just cold blasts of wind that say, uh-oh, we better pay attention. And then I think, for our purposes, the way we've experienced markets over the last several decades, this one's a big deal. This one I showed you the other day, got updated today. Individual investor bullishness, right? That's the green one. Bearishness is the red one. The life of the bear market, right? Here's right before it peaked at the gap. Market peaked, all-time high, 20-something% decline before it bottomed. And then as we moved our way up and down, this was a decent indicator to pay attention to, particularly when it crossed over. Crossing over, right? And then not crossing over again until here, but coming close. It was like 2/3 of the time when we got close and bullish sentiment was getting peaky, the market fell notably, frankly. Well, now this is far and away the most aggressive crossover, and we haven't been above 50 on bullishness since the market peak. So this is as peaky, as toppy as it's been since the beginning of the bear market. And then lastly, I'm going to pull over my blog post from yesterday morning. We got the update on the Intelligent Investors Advisor Sentiments, and we buy this from them. And as you can see here, and readers of the blog, I'm being redundant, but thank you for hanging in there. The bulls moved up to 53.4 from 51.3 a week ago. Most bullishness since November 2021, 2 months before the top, when it got to 57.2. That level suggests many pros have shifted their funds to equities, and I was flagging this here on the blog last 2 or 3 weeks. Overall, the bull count becomes a concern when it exceeds 55, so we're almost there. Bears are down to 20.6 from 21.6. Fewest bears since early January 2022. When was that? All-time market high. There was further expansion in the bull-bear spread, 32.8. You get above 30, and that's elevated risk. You need to start thinking about it. November 2021 was the last time we were above 30, all-time market peak. So I know you get where I'm coming from. And so essentially what I did here is, they mentioned November 2021 and January 2022, so that was right there and right there. And here's the market. Well, actually, here's the market since. So folks, again, the bottom line for this presentation is that, as always, we're humble. Market can do anything. We don't know what it's going to do over tomorrow, next week, next month, what have you. But when we look at all the indicators, and there's more than this, and there's some things that I'll probably share with you when I do the macro update here in a day, hopefully, that concern us right here. And today we rolled our hedges further out than we have been of late. So we're hedged close enough to the money with put options on the S&P out to July 31st. And we did that, spent a little bit more money on it because we think this is a window of risk right here that we want to make sure we get as much bang for our buck as we can as effective hedges to our client portfolios, if indeed we see something begin to develop to the downside between now and then. Other than that, I see a real big risk zone in the third quarter potentially, but right now things have rapidly moved to a point that, let me say it one more time, look toppy and unusually dangerous, at least over the near term right here. Does not mean that's going to happen. It just means smart, thoughtful, prudent investors make adjustments to compensate for the rising risk. Thank you, folks, as always, for watching and listening. Be back with the economic video hopefully by end of day or end of evening tomorrow. Take care. Bye-bye.